Hello and welcome to our discussion on the process of preparing the financial statements when the business transactions are given. So in this exercise, our focus is on some expenses which are paid, some expenses which are not paid, some in the advances from the customers, along with the normal usual transactions of money raised from the investors. So the first transaction is issued 5,000 equity shares, 50,000 equity shares of 2 at 2. So the company raised capital of 100,000, and this is a receipt and a source. Similarly, company raised a loan of 8% loan for 100,000, so therefore it is also a receipt and a source. It's not an income. Salary for the month 5,000, and salary is paid at the end of the month, and here the accounting period is quarter, so we are preparing the financial statement for the first quarter. So salary for the quarter is 15,000, 5,000 into 3, and we paid the salary by the end of the quarter 15,000. So every month end we pay 5,000. Rent per month 10,000, but it is due but not paid. So therefore rent is an payment, but we have not paid. Even if it is not paid, we have to show that as an expense because of the accrual concept. And since this is the quarter, so 30,000, which is equal to 10,000 into 3. Insurance premium were taken. The company took insurance policy, and the premium, annual premium is 12,000. So company paid 12,000 insurance premium. However, because of the matching principle, in the income statement will show the insurance only for 4,000. So therefore this is an example of a matching principle. And advance from the customer. During the first quarter we received advance from the customers of 50,000, but this is not an income for the period because it's an advance against which will provide services in the next time period, maybe quarter or maybe some other time in the future. So therefore, since this is an advance, we don't show that as an income in the current period, but any income received in advance is a liability. Any advance received from the customer is a liability. We also forgot to see this when we rent is 30,000 but not paid. Rent is a liability. We have to show the rent as a liability, or rent payable as a liability. No other transactions given here. However, there is a loan sitting on the balance sheet, and interest on that loan is 8%. So as per the accrual principle, we are bound to show the interest even if we don't pay the interest during that period. So because of the accrual principle, even if the company doesn't pay the interest, they have to show as an expense and create a liability called interest payable. So if all the transactions done, we will find the profit and loss. Since there is no income, the profit before tax is minus 51,000, and since it's a negative, so PAT is also be equal to PBT because there will be no tax. And PAT, or a negative profit, will reduce the equity, so we show that on the balance sheet as negative retained profit in the balance sheet. And we'll find that cash available is equal to 250,000 minus the payments, so therefore cash in hand is 223,000. So when we paid insurance, let me pick up one or two things once again. If you see the insurance premium, we paid 12,000, but expense is 4,000. So if any expense paid in advance, it's a benefit unexpired. So out of this 12,000, 4,000 is expense, and the balance 8,000 is considered as an asset. It's an asset because the benefit of that 8,000 is still to accrue in the next 3 quarters. So to repeat here, I say that any expense paid in more, then it is an asset. Whereas any income received, it's a liability because it's an income of the next time period. Similarly, expense due but not paid is a liability. In this case, rent and interest are expenses, but the payment has not happened, so therefore they are liability. Advance premium, to the extent of the premium belonging to the next time period, is an asset. So if the payment is more than the expense, is an asset. If the payment is less than the expense, is a liability. So cash in hand will be shown as an asset. So the profit goes to the balance sheet as a retained profit. Cash in hand goes to the balance sheet as the asset. So if all other transactions done, our sources should be equal to assets. So if you want to find out what is the equity at the end of the period, at the end of the quarter, 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 the equity is equal to capital plus the negative profit. So therefore, equity is less than the capital because of the negative profit for the period. And if the negative profit continues, then equity may become negative as the moment the negative retained profit becomes more than the capital. So assets or liabilities, okay, liabilities at the end of the quarter, is equal to loan payable plus rent payable plus advance from the customer plus interest payable is a liability. And assets is at the end of the quarter, and assets at the end of the quarter will be equal to, right, will be equal to 231. So 231. That also completes the accounting equation. The accounting equation says the assets of the company should be equal to E plus L. But the focus of this particular session is to drive in the relevance of recording the transactions as per the accrual and matching principle. So rent payable is a liability, advance from the customer is a liability, interest payable is a liability, whereas advance premium, expenses paid before the due, is an asset. Thank you very much.